F. Manage intercompany financing, including loans, repatriation, in-house banking. Intercompany financing is a key treasury management activity that supports efficient liquidity utilization across multinational organizations. Treasury professionals coordinate funding between parent companies, subsidiaries, and affiliated entities to minimize external borrowing costs, optimize working capital, and improve centralized cash management. Organizations with global operations often experience uneven cash positions among business units, creating opportunities to transfer excess liquidity internally instead of relying on external financing. Treasury teams evaluate operational needs, legal restrictions, tax implications, and foreign exchange considerations when structuring intercompany financing arrangements. Effective intercompany funding enhances financial flexibility, improves liquidity visibility, and supports strategic capital allocation while strengthening centralized treasury control throughout the organization. Intercompany loans are commonly used to provide short-term or long-term funding between related corporate entities. Treasury professionals structure these loans based on funding requirements, repayment capacity, interest rate conditions, and transfer pricing regulations. Loan agreements typically specify maturity dates, interest rates, repayment schedules, and currency denomination to ensure compliance with internal policies and regulatory standards. Treasury teams must consider withholding taxes, foreign exchange exposure, and local legal restrictions when arranging cross-border financing. Proper documentation is essential because tax authorities closely examine intercompany transactions to ensure arm's-length pricing principles are followed. Effective management of intercompany loans reduces financing costs, improves liquidity allocation, and supports efficient capital deployment across multinational operations. Repatriation refers to transferring cash, earnings, or profits from foreign subsidiaries back to the parent company. Treasury professionals evaluate various repatriation methods, including dividends, intercompany loan repayments, royalty payments, and management fees, to optimize liquidity while minimizing tax and regulatory costs. Decisions regarding repatriation depend on local restrictions, withholding taxes, foreign exchange controls, and overall corporate funding requirements. Treasury teams analyze whether excess offshore cash should remain invested abroad, support regional operations, or be returned to headquarters for broader organizational use. Effective repatriation planning improves liquidity availability and capital efficiency while balancing tax optimization, regulatory compliance, and strategic financial objectives across multiple jurisdictions. In-house banking is a centralized treasury structure that allows organizations to manage internal funding, payments, collections, and foreign exchange activities through a dedicated internal treasury center. Treasury professionals use in-house banking arrangements to reduce external banking transactions, improve cash visibility, and centralize liquidity management across subsidiaries. The in-house bank acts as an internal financial intermediary, facilitating intercompany loans, netting arrangements, and centralized payment processing. This structure improves operational efficiency, reduces transaction costs, and enhances control over global cash flows. Treasury management systems and enterprise resource planning platforms support in-house banking by automating settlements, reporting, and reconciliation processes. Strong governance and internal controls are necessary to ensure operational accuracy and regulatory compliance. From a CTP examination perspective, candidates must understand the objectives, benefits, and operational considerations associated with intercompany financing strategies. Exam questions frequently assess the ability to evaluate funding alternatives, analyze repatriation methods, interpret transfer pricing implications, and recommend centralized treasury structures for multinational organizations. Candidates should understand intercompany loan mechanics, tax and regulatory considerations, foreign exchange impacts, and the operational role of in-house banking systems. Knowledge of centralized liquidity management, netting arrangements, and cash pooling structures is also important. Mastery of these concepts enables treasury professionals to optimize internal liquidity utilization, reduce financing costs, and support efficient global treasury operations effectively.